Hello, this is Gary Sherman of Whaddadunce.com. Today we're going to look at portfolio performance. And the question that we are going to ask, and you should ask as an investor, is given that I have an investment in XYZ stock, how did that stock perform over time? And we will develop the equations for that, about how to look at stock price performance, but also we'll take a look at how actual companies performed, mainly Intel and a few others. The first thing that we want to do is define total return. So if you look at that first blurb, total return measures an investment's overall profitability, encompassing both capital gains and income generated. What that means is that if I take a look at, let's say, Intel stock today versus a year ago, any kind of increase in the stock price is going to be capital gains. But we also have to consider the dividends that were paid on Intel over that time period. So therefore, total return equals capital gains and losses plus dividends paid. Now, according to financial theory, over the long term, and this is something we discussed in Valuation Basics, over the long term, public companies earn their cost of capital. And what that means is if I have a cost of capital of, let's say, 9%, and I'm earning 15%, the question that you as an investor have to ask is, given that the competition that this company faces, wouldn't a 15% total return versus a 9% total return, which is the market total return, that's going to attract competitors. And the same thing with if I have a total return that's less than my cost of capital. That's going to basically says is I'm going to have some companies drop out, and as those companies drop out of the market, my total return is going to increase. So in the long term, public companies earn their cost of capital. So we have whenever we compare performance, we have to look at the beta values for each stock. Beta is a measure of volatility. As a whole, risk-averse investors do not like volatility. They would much rather invest in an investment with little volatility versus one that has markedly more volatility. That's just a definition of being risk averse. So whenever we calculate a total return over stock, we have to also consider the beta of that stock. So a stock with a beta over one, that should earn over the market rate of total return, and the total return on the S&P 500 composite over more than a 100-year period has been around 9.53%. So a stock that has a beta over one should earn more than 9.53%, and a stock that has a beta less than one should earn less than 9.53%. And then we're gonna ask the question and answer the question about portfolio performance. In other words, what are Bank of America, Amazon, Intel, and American Airlines total return over their entire share price history, and which stocks were good investments and which stocks were bad investments? It's simple. All we have to do is calculate the total return for those four companies and compare it to the cost of capital. So if I have a company that earns more than the cost of capital, then that's definitely a buy. If I have a company that's earning its cost of capital, then that's a hold. And if a company is earning less than its cost of capital, that's a sell. Now, these total returns are based on past performance. And anytime you look at an investment product, it always says, in pretty much close to the top, is that past performance doesn't necessarily mean that future performance will equal what is performed in the past. So we have to keep that in mind. But looking back into history to see what a stock actually returned versus what the market expects it to return is a good way of looking at investments, and that's what we'll do here. In this slide, we'll take a look at the S&P 500 composite total return. And remember, total return equals capital gains and losses plus dividends. So if we look at the graph, we can see that this time series goes more than 100 years, and it's pretty volatile. And just to look at a couple data points, look at for the Great Depression, which was 1929 till pretty much the start of World War II. And we can see that total return really took a dive. The same thing in 2009. We can see that total return took a dive. That was the Great Financial Crisis. And if we look at the table to the right, the time period goes from 1900 to 2024, so it's over 100 years of history, and that the mean value or the mean total return over that entire period of time was 9.53%. In this slide, we'll take a look at S&P 500 composite dividend yield. And remember that dividend yield equals dividends paid over the share price. And we can see by that chart is that dividend yields have been decreasing. So in other words, companies are retaining more of their cash that they could have used to distribute to stockholders. They're basically keeping that on balance sheet in the form of cash balances, marketable securities, that kind of stuff. So if we take a look at the table to the right, again, that time series, this is a Shiller time series. It goes from 1900 to 2024, and that the median value of the dividend yield was about 4.09%, and the median was 3.97%. So we can basically say that the average dividend yield is about 4%. But we also take into account that that dividend yield currently in 2024 is around 20 or around 2%. So that's reflected in the graph where we have a time series where we have high dividend yields, which decreases to the present. So even though the average over that whole time period was 4%, dividend yield, what we are currently paying, or what companies are currently paying in the S&P 500 is around 2% as far as dividends. So they're retaining a lot of their earnings in the form of cash or marketable securities. So come join our community. We have some web software that in the sections on valuation basics and this section on portfolio performance, there's going to be a lot of numbers thrown around. And all these calculations are made in the software, so you as an analyst don't have to go back and recreate the wheel. You can see the summary data and make some decisions on your own and value shares of the companies that you're interested, on your own, so that you can, make an informed decision on what should I buy the stock, or should I hold the stock, or should I sell it short. So with that said, we'll continue on with the presentation on portfolio performance.